Zone 7, please.
Hi, my name is Brandon Vecchio, and I'm in the Academy of Finance at Northwest High School here in Omaha. Could you explain the criteria you look at when selecting your stocks?
Well, we look at, and I'm glad you came. I hope there's a large group. I got a note, I think, from your teacher on that. We look at it, the criteria for selecting a stock is really the criteria for looking at a business. We are looking for a business we can understand. That means they sell a product that we think we understand, and we understand the nature of their competition, what could go wrong with it over time. And then when we find that business, we try to figure out whether the economics of it, means the earning power over the next 5 or 10 or 15 years, is likely to be good and getting better or poor and getting worse. But we try to evaluate that future stream. And then we try to decide whether we're getting in with some people that we feel comfortable being in with. And then we try to decide what's an appropriate price for what we've seen up to that point. And as I said last year, what we do is simple but not necessarily easy. The checklist that is going through our mind is not very complicated. Knowing what you don't know is important, and sometimes that's not easy. And knowing the future is definitely it's impossible in many cases in our view, and it's difficult in others, and sometimes it's relatively easy, and we're looking for the ones that are relatively easy. And then when you get all through, you have to find it at a price that's interesting to you, and that's very difficult for us now, although there have been periods in the past where it's been a total cinch. And that's what goes through our mind. If you were thinking of buying a service station or a dry cleaning establishment or a convenience store in Omaha to invest your life savings in and run as a business, you think about the same sort of things. You think about the competitive position and what it would look like 5 or 10 years from now, and how you were going to run it, who was going to run it for you, and how much you had to pay. And that's exactly what we think of as when we look at a stock, because a stock is nothing other than a piece of a business. Charlie?
Yeah, if finance were, when finance is properly taught, it should be taught from cases where the investment decision is easy. And the one I always cite is the early history of National Cash Register Company, and that was created by a fanatic who bought all the patents and had the best sales force and the best production plants, and he was a horse in the best production plants, and he was a very intelligent, was a godsend to retailing when cash registers were invented. So that was the pharmaceuticals of a former age. If you read an early annual report prepared by Patterson, who was CEO of National Cash Register, an idiot could see that this was a talented fanatic, very favorably located, and that therefore the investment decision was easy. If I were teaching finance, I would collect 100 cases like that, and that's the way I would teach the students.
We have that annual report. What was that, 1904 or something, Charlie? But it's really a classic report, because Patterson not only tells you why his cash register is worth about 20 times what he's selling for to people, but he also tells you that you're an idiot if you want. But he also tells you that you're an idiot if you want to go in competition with him. It's a classic.
It is just a total report, and not realize that this guy can't lose.
Area 8, please.
Good afternoon. My name is Robert Rowland from London, England. I've been in Omaha all weekend with my wife on the first leg of my honeymoon, and I've noticed you're quite a buyer of nostalgic assets. Can I ask whether nostalgia is one of your filters? Are there any assets like that left in the US to buy? And if not, can I suggest you come to the UK, where all we do is sell them?
Well, I don't want to interrupt your honeymoon, but if you'd send me a list of those companies over there that are long on nostalgia, that might be to our liking, because Charlie and I tend to operate from sort of a Norman Rockwell frame of mind, and it is true that the the kind of companies we like sort of do have a homey Norman Rockwell Saturday Evening Post type character to them. They have character, and they're the kind of companies I think frequently that people, when they join them, expect to spend the rest of their lives there rather than look at it as something to stick on the resume. And there are businesses like that. If you look at the businesses that we've bought in the last 3 or 4 years, there is real character to the businesses and to the people that build them, and that's why the people that build them stay on and feel very strongly about running them correctly, even though they can have no financial consequence to themselves whatsoever. So even though they can have no financial consequence to themselves whatsoever. So after your honeymoon, drop me a line. Zone 9, please.
Good afternoon. Joshua Andrews from Omaha Northwest High School, Academy of Finance.
Good.
And on behalf of the Academy of Finance, we want to thank you for the tickets. There's 33 of us in attendance today.
Terrific.
We had the opportunity to play a national game, an investment challenge. And on the list of stocks, there were Berk A and Berk B. Can you explain what the difference of the two stocks are?
Yeah, the difference between the Berkshire A and B is simply that an A can be converted to a B at any time in the ratio of 1A into 30 Bs. The B cannot be converted into the A, so it's a one-way street into 30 Bs. The B cannot be converted into the A, so it's a one-way street on of the B is exert. So anytime the A ever gets any money of any kind from dividends or liquidation or a merger or something of the sort, for every $30 that you get on the A, you're going to get $1 on the B. The two differences are that there is less voting power proportionately in the B, and the B does not participate in a designated contributions program that Berkshire runs, simply because that would be very, very hard to administer. And when we issued the B, we pointed out those two differences. The B should never sell for more than 1/30th of the price of the A. When it sells just a tiny bit above that, then arbitrage settles in as people buy the A and convert it to B and sell the B. Occasionally the B may be at a slight discount to the A because it's not convertible the other way. But I think as a practical matter, you can treat the A and B as very equivalent investment choices. There's A and B as very equivalent investment choices. There's Area 10, please.
My name is Sheena Sho from the Academy of Finance. What recommendations would you give us as teenagers to prepare for our future and become as successful as you?
Well, if you're interested in business, I definitely think you ought to learn all the accounting you can by the time you're in your early 20s. Accounting is the language of business. Now, that doesn't mean it's a perfect language, so you have to know the limitations of that language as well as all aspects of it. So I would advise you to learn accounting, and I would advise you to be, in terms of part-time employment or anything else, work at a number of businesses. There's nothing like seeing how business operates to build your judgment in the future about businesses. When you understand what kind of things are very competitive and what kind of things are less competitive and why that works that way, all of that adds to your knowledge. So I would do a lot of reading. If you're interested in investments, I would take the accounting courses. I do a lot of reading about investments, and I would get as much business experience. I would talk business with people that are in business to find out what they think makes their operation tick or where they have problems and why. I just think you just kind of sop it up every place that you can, and if it turns you on, you'll do well in it. I mean, I think that if it there certain activities grab different people, but if business is of interest to you, my guess is you'll do well. And if you understand business, you understand investments. Investments are simply business decisions that, in terms of capital, investments are simply business decisions that, in terms of capital.
Yeah, there's also the little matter of underspending.
Mastered.
Yes. That really works if you keep at it.
Yeah, I mean, Charlie and I both. Charlie started having children at a rapid rate, so he was a lawyer when there was not big money, and then, but I was any money you save before you get out and start having a family is probably worth, any dollar is probably worth $10 later on, simply because you can save it. It's the time to save is young, and you'll never have a better time to save than really pre-formation of a family, because the expenditures come along then, whether you like them or not. So work for yourself first and put the money aside. I was lucky that way. I didn't have to pay for my own college. Probably wouldn't have gone to college if I'd had to pay for it. But I was able to save everything I made in my teens, and those dollars got magnified quite a bit. Whereas the money when I started first selling securities, I mean that the money I made then was taken up by family needs to quite an extent. So start saving early. A lot of it's habit anyway, so it's a great habit to have. Okay, zone one, please.
I'm Tony Alsnett from New York City. Following up on the questionnaire from London, in light of the current dearth of investment opportunities, do you see yourselves investing in non-U.S. companies which are well managed, understandable, and growing?
Well, if we find such companies as you describe at a price that's half attractive, we're perfectly willing to buy them. So the answer to that is yes, but we would be looking to an extent worldwide, irrespective of market conditions in the United States. Now, market valuations in this country tend to be fairly well matched in most of the major countries. So there's been a bull market all over the world in a huge way in the bigger markets, and so unfortunately, I mean, it would have been nice for us if the U.S. market had tripled and other markets had stayed the same, and then we would be very likely to be finding things abroad. We're not finding them abroad, but we're certainly looking for the kind of thing you're talking about. We are not reluctant to invest abroad, and our all three of our largest holdings, American Express, Gillette, and Coke, and we're talking about $25 billion of market value there that we have. All three of those have major businesses abroad, and in the case of Coke and Gillette, it's a majority of their earnings from abroad. So we're interested, and there's better growth opportunities in many areas abroad than here. Finding bargains as we look around the world. Charlie?
Nothing more.
Okay. Area 2.
My name is Henry Allen from Mamaroneck, New York. Question I have is a little delicate, relates to my family and heirs rather than myself, because I'm a couple of decades older than you gentlemen. You've been very candid about the succession and the estate planning, but how will the recipients of huge grants, charitable grants, get the liquidity they need to use the money without unduly driving the stock down?
Well, I don't think that supply and demand in terms of specific, let's just say that 3% of Berkshire were to be added to the supply annually. I don't think that makes much difference. What really makes the difference is the prospects of the business. If my charitable foundation were operative today, it would have to sell. It would have to give away 5% of the value of the foundation every year. And if Berkshire paid no dividend, that means it would have to sell 5% of the holdings per year. I don't think that the price of Berkshire would be materially different if there were a seller of, that would be, in this case, 2% of Berkshire's capitalization. I don't think it would be materially different. If it is, it probably should be different. I mean, there should be a reasonable amount of trading that can take place annually without affecting the price of the stock materially, or the price of the stock is being propped for sort of unnatural reasons. So I wouldn't really worry about that. We had one shareholder die about a year and a half ago that had 0.75% of the company, for example. It was sold in, I don't know, 6 weeks or thereabouts, and they raised at that time $250 million or thereabouts from the sale. I am not worried about that. I'm worried about, I mean, I don't worry, but if, the key factor is, what are the prospects of the businesses? If the businesses are worth money, there are all kinds of companies on their stock exchange who are perfectly decent businesses where 30 or 40% of the stock turns over a year, and Berkshire's price should not be way different if 10% trades a year as opposed to the present 3%. Charlie?
I agree with that. I don't think there'd be any problem at all at the present time if the Buffett Foundation were selling 5% of its holdings every year.
It'd be 500 shares a week or something like that. But if there isn't demand for 500 shares a week on a company with our capitalization, then the price probably is artificially wrong at that time.
But I just had lunch with Susie, and she doesn't look to me like she's in any imminent danger of mortality.
Yeah, it will come into play when the survivor of the two of us dies, and when the estate gets cleaned up and everything else. So I think, certainly hope, and I think it's quite a ways away.
You people have more important things to worry about.
Zone 3, please.
My name is Jim Howard. I'm from Syracuse, Indiana. My question is, does the book Buffettology by Mary Buffett present fairly, in all material respects, the calculations you used in evaluating the business for purchase, or did the lady just write a book?
Well, it was written by two authors, but I would say that no, I would say that in a general way it gets at the investment philosophy, but I wouldn't say that it's not the book I would have written precisely, but I have no quarrel with it either. I actually think by reading Berkshire's reports, you should be able to get more. I would think you get more of our philosophy than in any other manner. I think Larry Cunningham, the fellow who held the symposium at the Cardozo School at Yeshiva, did the best job actually of sort of reconstructing the various things that have been written at Berkshire into sort of the best organized presentation of our philosophy. So
he's selling it right here. It's a very practical.
Yeah, he had it at Borsheim, in the mall outside Borsheim yesterday, and Larry did a very good job, and I had nothing to do with it, but I think I really think he's done a first-class job of sort of organizing by topic. I mean, all these things that I've sort of written annually, and Charlie's written over time. So that would probably be my, if I were picking one thing to read, that would probably be the one. Okay, Zone 4, please.
My name is Leora Garner. I'm from Los Angeles, California, and I want to begin by thanking you for having Bob Hammond. It was a stroke of genius. I could shop at Borsheim's, and my husband was entertained. while I did so.
Well, Bob is not only the best bridge player around, but he is an entertaining guy, too.
He's great.
Yeah, he is great. I agree with you.
My question. You owned Disney once before and sold it. You also owned advertising companies in the 70s, I believe.
Right.
And you sold them. Could we have some insight into your thinking as to why you sold them?
I'm not sure I want to give you any insight into that thinking. Well, we'll start off with the fact that when I was 11, I bought some city service preferred at 38, and it went to 200, but I sold at 40. So, grabbing my $2 a share of profit. So everything we've ever sold has gone up subsequently, but some of them have gone up more painfully subsequently than others. And certainly the Disney sale in the 60s was a huge mistake. I should have been buying. I forget about holding. And that's happened many times. I mean, we think that anything we sell should go up subsequently because we own good businesses, and we may sell them because we need money for something else, but we still think they're good businesses, and we think good businesses are going to be worth more over time. So everything virtually that I can think of has gone on to sell it at a lot more money, for a lot more money, and I would expect that would continue to be the case. That's not a source of distress, but I must say that selling the Disney was a mistake, and actually the ad agencies have done very well since we sold them too. Now maybe some of that money went into Coca-Cola or something else, so I don't worry about that. I would worry, frankly, if I sold a bunch of things right at the top, because that would indicate that in effect I was practicing the bigger fool type approach to investing, and I don't think that can be practiced successfully over time. I think the most successful investors, if they sell at all, will be selling things that end up going a lot higher because it means that they've been buying into good businesses as they've gone along. Charlie?
Well, I'm glad that the questioner brought this touch of humility because it is really useful to be reminded of your errors. I mean, and I think we're pretty good at that. I mean, we kind of mentally rub our own noses in our own mistakes. And that is a very good mental habit. Warren can tell you the exact number of cents per share that he sold at and compare it with the current price. It actually hurts him.
It actually doesn't hurt. The truth is, because you just keep on doing things. But it is instructive to do postmortems on everything, and say, as long as you don't get carried away with it. But every acquisition decision, that kind of thing, there should be postmortems done. Most companies don't like to do postmortems on their capital expenditures. I've been a director of a lot of companies over the years, and they've usually not spent a lot of time on the postmortems. They spend a lot of time on telling you how wonderful the acquisitions are going to be or the capital expenditures, but they don't like to look so hard necessarily at the results.
Think of how refreshing the board of directors meeting would be if they sat down and now we'll spend 3 hours examining all our stupid blunders and how much we've blown.
And then after that, the compensation committee will meet. No, that is not going to happen.
Right.
Okay, area 5, please.
My name is Keller, Harpel Keller from Portland, Oregon. 2 questions, one of a personal nature. Obviously, there are many, many people here today, and I wonder if one of the true patriarchs of the investment business is here today, Phil Curray.
Well,
many of his friends and admirers would wish him well.
Phil, up till a week ago, was going to be here today. Phil is 101. Wrote a book on investments in 1924, and I've known Phil for about 46 or 7 years. And Phil has made all the meetings for a number of years. Would be here today, and he broke a hip about 5 or 6 days ago, but he sent a message that he will definitely be here next year. And he will be too. Sent a message that he will definitely be here next year. And he will be too.
second question has to do with Ben Graham. And he changed his valuation standards as the decades progressed. When he couldn't buy stocks below net, he changed his standards because the environment changed. Now, the world today seems to be at a much different place than in 1989 when the USSR collapsed. Even they are stumbling toward the free enterprise system. The Russian mafia is a perverse illustration of that. Now there is only one superpower in the world, the USA, and we must be extremely grateful for the men who put us on the track to the free enterprise system. Now, the free enterprise system is out of the bottle. It's not going to get back in. It seems to be expanding and accelerating around the world. With the resulting expansion of world trade, may that lead to a reevaluation of historical measures for measuring investments?
Well, my answer to that would be that I doubt it, but I also don't know. But I don't think that the end of the Cold War is something that I would factor into my evaluation of businesses. There are all kinds of events that happen, and their impact in terms of being quantified, very difficult to figure over time. Very difficult to isolate any single variable in a complex economic equation. So in terms of how the world is going to work 10 years from now, or the returns are going to be on equity in business, I don't know what will be all the variables that impact on that. And obviously, right now people are very bullish about the fact that those returns, or something like those returns, will continue. But I would not rely in making such a projection on the fact that the Cold War has ended, or really any political or economic development around the world. I don't know how to predict future earnings of American business. And when I look at all of the great historic events of the past, nothing there gives me much in the way of a clue as to which ones would signal major changes in profitability of American business. Charlie?
Well, I think you raised one very interesting question. If the rest of the world becomes very much more prosperous, as it will if it adopts the free enterprise system, which investments are likely to do best? I would argue that the Cokes and Gillettes and so on are likely to be helped by a great increase in prosperity in what is now the third world. And I'm not so sure that's true of a lot of other businesses.
We like the international businesses we have, and as I say, that our three top holdings all have a major international aspect to them, and really in aggregate a dominant international aspect to them. And there's no question in my mind that a Coke will grow faster outside of the United States than in the United States, and the same is true of Gillette, and really the same is true of American Express. So that's built into our evaluation of those businesses. But I felt that way before 1989 too. I mean, it's very hard to evaluate how the ball is going to bounce generally, but around the world. But it is a plus to have products such as Gillette has or Coke have that have demonstrated the fact that they travel extraordinarily well around the world, that people crave those products, and that they're going to no one's going to find a way to do it better than those two companies in their respective fields. So, and they sell an inexpensive products. So all of that's going for us. But in terms of how stocks generally sell, or the profitability of American business generally is in the future, it doesn't help me. Generally sell, or the profitability of American business generally is in the future, it doesn't help me anymore.
Hi, My name is Bartley Cohen. I just want to thank you for a great weekend. And my question is, after you bought Dairy Queen, I heard they put Coca-Cola into all the stores. But yesterday, when I went to the Nebraska Furniture Mart, they said they don't take American Express. And my question is, do you encourage the subsidiaries and the companies that you have stock to use each other's products, or do you leave it up to the management of the subsidiary?
Well, that's a good question, and it does tell you something about the Berkshire method of operation. We tell each subsidiary to run their business in the way that they think is best for their operation. And Borsheim's takes American Express, See's takes American Express, the Furniture Mart doesn't, for example. But that'll be true in other areas too. If Harvey Golub at American Express, who has absolutely done a sensational job for us, if he wants to talk with or have his representatives talk with anybody at any of our operations, we're all for that happening, but we will never tell a subsidiary manager which vendor to patronize or anything of that sort. Once we start making decisions for our managers in that respect, then we become responsible for the operation, and they're no longer responsible for the operation. They are responsible for their operations, and that means they get to call the decisions, and they should do what is best for their subsidiary, and it's up to any other company that wants to do business with them to prove why that is best for them. And that's the Berkshire approach to things. And I think on balance, our managers like it that way. So they're not getting second-guessed, and somebody can't go over their head. I get letters all the time from people who are trying to jump over the heads of our managers, and they want us to say this advertising agency should be used or that and that sort of thing. And it doesn't work at Berkshire. They deal with the managers of the businesses, and they're not going to get around them. Charlie?
I love your answer. It gives Warren lots of time to read annual reports at headquarters.
Area 7.
Hello, my name is Steve Errico. I'm from New York. What do you think is likely to happen with respect to the tobacco settlement, and what do you think should happen? And secondly, McDonald's and Dairy Queen are similar businesses. Was there a relationship between your acquisition of Dairy Queen and the disposal of McDonald's? Thank you.
Yeah, there's no connection in the second case. They have certain similarities, but there's certainly a lot of differences too. A Burger King and McDonald's would be much more similar, or a Wendy and McDonald's, but Dairy Queen is much more of a niche than away from that. The tobacco settlement's interesting, just in terms of watching the dynamics of it, because one of the things in labor negotiations is always a problem is that when you, as a manager, you have a labor negotiation, at the end of the negotiation, you as management are committed, and basically the union isn't, because the union is going to have a vote on it, and that's just the way it is. I mean, you can't get away from that, but it is not fun to be in a negotiating position where you're bound and the other side is not bound. And although that wasn't totally contractually necessarily the situation in the tobacco area, it smelled like trouble to me for the tobacco companies, whether you feel they should have had that trouble or not, but it smelled like trouble to me when they were bound and you had another side that was not bound in any way, and where there were lots of political considerations, and where there was a lot of time was going to expire. I mean, that did not smell to me like a deal that would stick. And I don't know any of the tobacco executives that were involved in that, but I don't know how much they agonized over getting in a position where they were bound and the other party wasn't. But I can tell you from labor negotiations that's not a pleasant place to be, and it's not a great strategic place to be. Charlie, what do you think on that?
I don't feel I've got any great expertise in this situation.
Well, neither did I, but Okay, zone 8, please.
Hello, I'm Jamie McMahon from Birmingham, Alabama, and I was hoping that Mr. Buffett and Mr. Munger, y'all would expand a little bit on your ideas of an inheritance and the positive and negative influences that can have on your heirs, and what you might be able to do as a business person and an investor and as a parent to sort of mitigate those negative influences.
Yeah, well, I quoted, I think Kay Graham was quoting her father at the time, but some years back as saying, if you're quite rich, probably the idea of leaving your children enough so they can do anything but not enough so they can do nothing is not a bad formula. I think if you're talking about people that aren't quite rich, I've seen, socially I wouldn't have a system that involved inheritances, but recognizing the situation that exists, I think probably at lower levels, that leaving to the children in this society is perfectly okay. But I believe enough in a meritocracy that if I were devising the system with a consumption tax and everything, I would probably make inheritance a form of consumption, and it would be very heavily taxed, because I don't believe that because you happen to come out of the right womb, essentially, that you are entitled to live an entirely different life than somebody who wasn't quite as lucky in terms of womb selection. But in my own case, I follow the enough so they can do anything, but not enough so they can do nothing. I think that society showered all these. I was very lucky. I was wired the right way at the right time in history to do very well in this kind of a market economy where, as Bill Gates has told me, if I was born some thousands of years ago, I'd been some animal's lunch. I don't run very fast, and there are different assets that are useful at different times, and I'm not wired to play championship bridge or championship chess, or I'm not wired to be a basketball star or anything. It just so happens I'm in an area where it pays off like crazy to be good at capital allocation, and that doesn't make me a more worthwhile human being than anybody else or anything. It just means I was lucky, and should that luck enable many generations of people that I would have some reservations about that. So that's my own feeling on inheritance. But Charlie has a bigger family, and he can give you a better answer.
Well, I feel in a capitalist system that there should be an inheritance tax, and that once that's been imposed and paid, what each person wants to do in his own testamentary arrangements is up to that person. I see very few people that I regard as ruined by money. Many of the people that I see ruined who have money would have been ruined without money. And I think the percentage of the people that are going to be living the life of the French aristocracy before the revolution is always going to be very small, and living the life of the French aristocracy before the revolution is always going to be very small, and there are plenty of grasping people to take the money away from the whole class of incompetents ruling the world as their money cascades ever higher. So I like a fair amount of charity, and certainly some testamentary charity is okay, but I feel it's an individual choice that people have to make.
They get a choice there. Number 9.
My name is Samuel Wong from Irvine, California. I have 2 questions. Question number 1, do you think the USA market is overvalued today? And question number 2, would you buy Berkshire Hathaway stock today? Would you buy Berkshire Hathaway stock today, considering the fact that they have a nice run up? If yes, presuming I have a kid, 20 years old, and he has $150,000 to invest in Berkshire Hathaway, and he won't need the money until 5 years later, gradually, would you recommend to buy A share or B share or the combination? Thank you.
If you decide to buy Berkshire, I don't think it really makes much difference whether you buy A or B. But we don't make any recommendations about whether people buy or sell Berkshire. We never have, and that's a game we don't want to get into. In terms of overvalue, the question of whether the market's overvalued generally, it's simply as we said last year here in the annual report. It's not, the general market is not overvalued if two conditions are met, which is, in our view, which is that interest rates remain at or near present levels or go lower, and that corporate profitability in the U.S. stay at the present or close to the present levels, which are virtually unprecedented. Now, those are a couple of big ifs, as we pointed out. A lot of the stories that came out after the annual report would emphasize one aspect or another, but it's simply, and they say, what does he mean by that? Well, it means exactly what I say. If the two conditions are met, I think it's not overvalued, and if either of the conditions is breached in an important way, I think it will turn out to be overvalued, and I don't know the answer, which is why I put it in the form that I did. It's very tough at any given time to look forward and know what level of valuation is justified. You do know when certain dangerous things appear, and certainly if you're predicating your answer that stocks are okay at these prices, you have, if you come to that conclusion, you have to also come to the conclusion that, in our view, that corporate earnings at present levels are likely to be maintained, and that's a conclusion you would have to come to. I don't think it's obvious that that's the case. Area 10, please.
Good afternoon. My name is Jamie Harmon, and I'm from Boston. You say that companies should only spend $1 on capital expenditures if it will create more than $1 of market value. I'm wondering, how do you determine this? Is it based on A, historical returns on capital, B, a qualitative judgment of the company's competitive position, historical returns on capital, B, a qualitative judgment of the company's competitive position, a quantitative projection of the returns on capital, or D, something else?
We can say, to date, every dollar we've retained has been worthwhile, because on balance, those dollars have produced more than $1 of market value, and it's actually, with a great many companies, you could say that now, because things have turned out so well. But it would be a case, the check on it is if after 3 or 4 years you found that the dollars we retained haven't created more than value, then the presumption becomes very strong at that point that we should start paying out money. But almost any management that wants to retain money is going to rationalize it by saying we're going to do wonderful things with the money we retain. And we think there should be checks on that, which is why in the report, in the ground rules, I suggest making checks on the validity of those projections. Charlie and I, if you asked us today whether the single dollar we retain from the earnings today we've got a use for today that will produce more than $1 of value, the answer is no. We do think that based on history that the prospects are that better than 50%, well over 50%, that in the next few years we would have an opportunity to do that. But there's no certainty to it. Charlie?
Nothing more.
Okay. Area 1, please. Charlie?
Nothing more.
Okay. Area 1, please.
Good afternoon. My name is Gary Bialis. I'm from Southern California. I want to thank you again for producing Can you tell me if the rule of thumb is still applicable regarding the statement in the owner's manual that the percent increase in the book value tracks pretty well the percent increase in intrinsic value? Or is the fact that you now have more owned businesses, especially ones like Geico and Flight Safety, mean that the spread between those two is possibly narrowed?
Well, the two have tracked pretty well over the years. I mean, compared to the record of most businesses that are publicly owned, I would say that over the 33 or so year span, our market price has tracked intrinsic value more closely than 80 or 90% of the companies that we view, probably 90%. But that doesn't mean it does it all the time. And there are times when the market, but that doesn't mean it does it all the time. And there are times when the market has the change in intrinsic value, and there are times when it, obviously then that it will lag behind. So it's far from perfect, but it's better than most. Ideally, we would like it to track it perfectly. If we ran this as a private company and we met once a year and set a price on the stock to have it traded once a year, and Charlie and I were responsible for setting that price, we would try to set a price that was as close to intrinsic value as we could, and that would be, to the extent that we could do it, it would be a perfect tracking. The market isn't like that, and the market responds to a lot of other things. So it's not perfect. It's not getting more perfect in our view, but we still think that Berkshire companies. Charlie, companies. Charlie,
nothing to add.
I'm Elizabeth Cruz from New York City. I have a question about Gillette. Another significant Gillette investor, KKR, recently sold over $1 billion in Gillette shares that they had acquired through Gillette's acquisition of Duracell. Knowing that KKR has also been a successful investor, do you see this as a negative signal about Gillette's future prospects, particularly on the eve of the launch of the Mach 3 razor? And what do you think their plans are for the remainder of their shares?
Well, I think they may have even publicly stated, I'm pretty sure they have, the Duracell shares, from which the Gillette shares came, were held by a specific investment fund that was formed in I don't know what year, but a given year, and which is scheduled to disband at a certain point. So those shares, whether they were of Duracell or whether they're of Gillette, were scheduled for disposition at some point within a given term. And I think that KKR made the decision, and they've made it with other stocks too, is to have maybe 3 or so offerings between now and that terminal date for their partnership. And why they pick any any given date, is up to them and their advisors. It means nothing to us. I mean, if they didn't have that kind of a fund and they decided to sell, it wouldn't make any difference to them. And I presume if we made a decision to sell, it wouldn't make any difference in their case. So we form our ideas of valuation independent of anybody else's thinking on it. But in the case of KKR specifically, they have a termination date on a partnership that own those shares and have to dispose of them one way or another between now and the termination date, and probably decided that with the quantity of stock they had that they were going to have several sales. The Mach 3 is terrific, and quantity of stock they had that they were going to have several sales. The Mach 3 is terrific, incidentally. I've been using Mach 3. Area 3, please.
I'm Gertrude Goodman from Palm Springs, California. Mr. Buffett and Mr. Munger, there are many stocks that rise and eventually split. My question is, do you foresee in the near future a split for Berkshire Hathaway Class A?
Well, that's an easy one. No, the answer is no. We have no plans to split the A. In effect, we let people who want to split the A split it themselves into B. So anybody that owns the A can have a 30-for-1 split any morning they wake up and want to have such a split. And Charlie, do you have any additional comment?
No, I think you said no perfectly.
We don't take that attitude because we're cavalier about how shareholders feel. We really think that in the long-range interest of Berkshire, that the policy we followed on not splitting has benefited the company and shareholders. Nothing dramatic about it, but I think that we have a better class of shareholders in aggregate in this room than we would have if we were selling at $3 a share or $30 a share or maybe even $300 a share. Area 4, please.
Good afternoon, Mr. Buffett and Mr. Munger. My name is Jack Sutton from New York City. I have two questions. The Japanese stock market has been likened to the U.S. market in 1974. With Japanese stocks selling at very low price-to-book values as compared to U.S. stocks, would it not make sense to invest in a basket of Japanese stocks or an index fund of Japanese stocks? Question number 2. Berkshire Hathaway tends to invest in companies with high margins and high return on common equity. Berkshire's investment in the airline business seems to have digressed widely from those principles. Could you elaborate on why Berkshire invested in the airline industry, and would Berkshire consider new investments in the industry in the future?
And going to the first question, the reason that, and I don't know the exact figures, the Japanese stocks would sell at a lower price-book ratio than U.S. stocks is simply because Japanese companies are earning far less on book than American companies, and earnings are what determine value, not book value. Book value is not a factor we consider. Future earnings are a factor we consider, and as we mentioned earlier this morning, earnings have been poor for a great many Japanese companies. Now, if you think that the return on equity of Japanese business is going to increase dramatically, then you're going to make a lot of money. I mean, and you're correct, you're going to make a lot of money in Japanese stocks, but the return on equity for Japanese businesses has been quite low, and that makes a low price-to-book ratio very, very appropriate because earnings are measured against book. And if a company's earning 5% on book value, I don't want to buy it at book value if I think it's going to keep earning 5% on book value. So a low price-book ratio means nothing to us. It does not intrigue us. In fact, if anything, we are less likely to look at something that sells at a low relationship to book than something that sells at a high relationship to book, because the chances are we're looking at a poor business in the first case and a good business in the second case. What was the other question on Charlie?
Buying it.
Airlines. Oh, yes, I always repress everything on airlines. I don't want to. We've never bought an airline common stock that I can remember. So what we did was we lent money to U.S. Air for a 10-year period, and we had a conversion privilege there. It looked like it was a terrible mistake. I made the mistake, but we got bailed out. But we never made the determination. When we bought our stock, U.S. Air was selling at $50 a share or thereabouts, the common. And we didn't have an interest in buying U.S. Air at 50 or 40 or 30 or 20. And we got a chance to as things went along, all the way down to 4. And we never bought it. And we never bought American or United or Delta or any other airline. It is not a business that intrigues us. We did think it was intriguing to lend money to them with a conversion privilege, and it's worked out now because we got lucky, and because Steve Wolf came along and really rescued the company from right at the brink of bankruptcy. But we're unlikely to be in airlines, although, again, we wouldn't mind lending money to a lot of businesses that we wouldn't buy common equity in. I mean, that could happen again in various industries, including the airline industry. Charlie, do you have anything to say on either the airlines or the Japanese market?
Well, the airline experience was very unpleasant for us. The net worth just melted. It was like $1.5 billion, and it just went 100 million, 100 million, 100 million. And finally the cash is running down. It is a very unpleasant experience. And we try and learn from those experiences, but we're very slow learners.
Japanese market?
Oh, the Japanese market. I suppose anything could happen. After all, we bought silver. But we have never made a big sector play on a country. In fact, we've almost never made a big sector play.
We would have to come to the conclusion the Japanese business, instead of earning whatever it's earning on equity now, is going to earn appreciably more on equity. I've got no basis for, I wouldn't argue with anybody else feels that way. I wouldn't argue with them, but I have no basis for coming to that conclusion. And unless you come to that conclusion, you're not going to make good returns. I mean, unless that happens, you're not going to make good returns from Japanese stocks. You can't earn a lot of money from businesses that are earning 5% on or 6% on equity. And I look at the reports, but I don't see the earning power now. Now maybe it'll all change. I mean, there's talk of, well, there's already been a small temporary tax cut, but corporate tax rates are quite high, as you know, in Japan, and they used to be 52% here in the United States. Now they're 35%. So you could have things happen that increase corporate profits, but I don't have any special insight into that anyone that reads the press generally would not have.
There are also readings in corporate culture that have to be made. Owning stock in a corporation where you know that if shareholders or somebody else has to suffer, the choice is likely to be that somebody else will be chosen. That is a different kind of a company to invest in than one that thinks that the principal purpose of life is to keep some steam boiler company going in a particular community or something, no matter how much the shareholders suffer. I think it's hard to judge corporate culture in the foreign countries as well as we can judge it in our own.
Area 5.
Yvonne Edmonds from Cedar Mountain, North Carolina. I have a specific question, but not a trivial one. You regularly compare Berkshire Hathaway's performance to the S&P 500, which is very helpful and very interesting. But I haven't seen a correlation coefficient between the S&P 500 daily, from day to day performance, the close, say, and Berkshire Hathaway's close. Now, it so happens for me, and I'm sure some other people in the audience, that I don't always have access to newspapers, or the internet for that matter, newspapers that publish Berkshire Hathaway performance on a daily basis, or even a weekly basis for that matter, or a monthly basis. It would be very helpful to know the extent of a correlation coefficient between those two variables. If you have that, would you let us know what it is? And if you don't, would you please consider calculating it in the future?
Well, it could be calculated, but I don't think it would have much meaning. I mean, it would be an historical correlation coefficient, which, you know, I would be very reluctant to have people place any weight in. I try to indicate even the limitations of the yearly comparison of the relative performance, because what was doable by us in the past is not doable today. I mentioned in my annual report the best decade I ever had on comparative performance by far was the 50s. Now, I don't think it was because I was a lot smarter then. I'm unwilling to accept that. But, you know, I had some edge of, well, there's probably 40 plus points per year. But I was working with it. That has no relevance to today whatsoever. It would be misleading to publish it or to make calculations based on it. So I think that you would find, I don't know what you'd find on a specific correlation between Berkshire and the S&P. You'd find a lot of correlation. Well, you might not find so much even. You'd find it in intrinsic value between that and Coke and a few stocks like that. But I don't really think that's particularly useful information going forward. We'd have no objection. Anybody wants to make the calculation, but it wouldn't be something that would be of any utility to us. And if we don't think it's of utility to us, we don't want to put it out for shareholders as being a possible utility. We do think that the S&P annual calculation has some meaning because it's an alternative for people to invest. They don't need us to buy the S&P. So unless over time we have some advantage over that, what are we contributing? What value is added by our management? So we think that people should hold us accountable, even though we would prefer not to be, because that it is a tough comparison for us as a tax-paying entity against the pre-tax calculation on the S&P. But we don't pay any attention to beta or any of that sort of thing. It just doesn't mean anything to us. We're only interested in price and value, and that's what we're focusing on all the time. And any kind of market movements or anything don't mean anything. I don't know what Berkshire is selling for today, and it really makes no difference. It just doesn't make any difference. What does count is where it is 10 years from now. And I can't tell you what it was selling for on May 4th, 1983 or May 4th, 1986. So I don't care what it sells for on May 4th, 1998. I do care, where it is in general 10 years from now. And that's where all the focus is. Charlie?
Yeah, we're publishing data in the form where we would like it if we were the passive shareholder. And so you're getting the data and you're getting it on a time schedule based on what we would want if we were in your position. And we don't think the correlation coefficients would help us.
We don't think anything that relates either to volume, price action, relative strength, any of that sort of thing. And bear in mind, when I was in my teens, I used to eat that stuff up. I mean, I was making calculations based on it all the time and kept charts on it and even wrote an article or two on it. But it just has no place in the operation now.
One of the pleasant things about dealing with Warren all these years is he's never talked about a correlation coefficient. If the correlation isn't so extreme you can see it with the naked eye, he doesn't compute it.
Okay, we're going to go to